Well, hello everybody and welcome to Trending Treasury, the weekly webcast by Arlene Close. This week I'm joined by Toby Gibb from Fidelity, and we're going to be discussing the future for sustainable capitalism. Toby, just a bit of a sound check. Can you hear me okay?
I can, yes. Can you hear me?
Loud and clear, so that's perfect.
Perfect.
So we've managed to clear the first hurdle, which is always, does the technical stuff work okay? So how are you? Obviously we had the summer statement yesterday, and I think the thing in amongst talk of sustainable buildings for the public sector and stamp duty cuts, the thing that everybody seems to be interested in is the fact that the Treasury will be subsidising our lunches and our dinners through August. So have you got a nice big list of restaurants that you'll be rushing to in August?
Absolutely. Yeah, I think we have to do our bit. I guess one of the great benefits of the lockdown has been being able to spend a bit of time with my kids. And one of the things we've done is, every Monday gone out for lunch in what has been until recently a sort of takeaway cafe around the corner, but now maybe do that more than once a week. Maybe do that Monday, Tuesday, and Wednesday going forward, which would be really nice.
Yeah, exactly. Eat out to help out. That's what we've been told to do, and I'm sure that's something everybody's going to be willing to get on board with. So, without further ado, obviously the title of the webcast is "The Future for Sustainable Capitalism." I suppose we should start with what is your main thesis? What is driving, really, in your view, the need for us to discuss sustainable capitalism? What's wrong with capitalism as it is now? Why is capitalism as we have it now not sustainable?
Yeah, I think it's great way to start. I think we're at an inflection point. I think we're at an inflection point from a political perspective, a societal, economic, and a technological perspective. Over the last few years, we've seen real pushback against globalization, and we've seen some surprising changes in governments. We've seen a rise in civil unrest over recent years, but also over recent months. And I think the reason for this, or part of the reason for this, is the neoliberalist economics that have been with us for decades, and the focus on shareholders above all other stakeholders, which essentially has been the kind of the corporate code since the 1970s, have resulted in policies, have resulted in outcomes that only benefit a few. They don't benefit everyone. So as a result of this, we've seen a significant increase in wealth inequality, with the 1% essentially taking a greater and greater piece of the overall pie. This isn't just unfair. This is bad for growth. This is bad for the economy, because it's only really the middle class that can make the economy grow, not the rich 1% or 0.1% plutocrats. Because even if they're earning 1,000, they're earning 1,000 times more than the average, but they're not consuming 1,000 times more than the average. So we need a better spread of wealth, a better spread of sort of spending power across the economy for the whole of the economy to benefit. And I think this has been, you can see that the chart on the left-hand side is that growing inequality, that essentially the share of total income going to the top 1%, which has been rising quite rapidly since the 1970s. And on the right-hand side, I think this has been really sort of accelerated by monetary policy since the global financial crisis. So essentially by focusing on putting more and more sort of money into the system, lowering interest rates, but combining that with fiscal austerity, what we have seen is a significant rise in financial asset prices, but stagnant real economy prices. So those people that own financial assets, i.e. the richer, have benefited massively from this monetary policy, whereas those who don't have been left behind. And I think that has been a big driver of a lot of the as I said, the sort of pushback that we've seen. And I think this isn't just a top-down issue. I think from a bottom-up perspective, from a micro perspective, we have had this very significant focus on shareholder value and CEOs focusing on getting themselves richer and their shareholders richer. But I think we're now starting to see a fundamental shift there, and a move towards much more stakeholder capitalism rather than purely shareholder capitalism and market capitalism.
Well, that's quite an interesting view. I mean, I suppose the first thing that jumps out at me from your graph on the left, which is looking at total share of income for the UK, the United States, Canada, Ireland, Australia, is it feels like maybe it's only telling half the story, whilst we've seen a greater share of prosperity going to the 1%. When we talk about capitalism being sustainable, surely we have to talk about the impact that it's had on developing countries. And if we were to put on, the rather than the share of total income going to the 1%, the share of total income going to different countries, it'd tell a completely different story, a story of global inequality falling quite rapidly. How does that fit in with your views?
I think that's true. I think on a global basis, globalization and global growth has benefited emerging economies significantly, and we have seen millions moved out of poverty. However, within countries, the picture, I guess, is much more nuanced. So when you look at measures of inequality like Gini coefficient or the sort of the ratio of the top 10% versus the bottom 10% of income earners, actually those numbers are worse in a lot of emerging economies than they are in developed economies. So the level, although those economies have been sort of pushed up in absolute terms, within those countries the level of inequality is still very, very high. And I think why that's particularly pertinent at the moment is for developing economies to continue that path, to continue to bring people out of poverty and to get below, to get above the sort of minimum daily wage level, requires a growth rate of around 6 or 7%. And over recent years, China has well, depending on whether you believe the statistics, but has delivered that, and other emerging economies have also delivered that. But I think given what's going on at the moment, given the the economic uncertainty and the levels of growth that we're probably likely to see over the next few years, that sort of equation is not going to hold up, and it's going to put quite a lot of pressure on developing economies as well as developed economies.
And so you very much see this rise of inequality as fueling populism, or perhaps not populism, but populist parties. Can you sort of expand on that a little bit?
Yeah, I think we have seen clearly this acceleration in the wealth of the top 1% or the top 0.1%, and we've also seen I guess large parts of the population being left behind by globalization and by the policy measures that have been put in place by the global financial crisis, and as shown in the chart on the right hand side in front of us, and I do think that has been a big driver behind Trump's election in the US, behind lots of populist parties coming to power in Europe and elsewhere. And I think that's likely to continue.
I see. So, I mean, I know you've obviously fleshed out the issues with inequality and how that may or may not have added to some electoral impact. I mean, what do you think the impact of rising inequality and on decoupling asset prices, etc. How's that been affected by things like QE, and has that had an issue with general economic concepts that we'd hold to be relatively standard?
Yeah, I think it has. I mean, I think quantitative easing has, I guess what was the sort of the driver behind that was to try and essentially pump money into the economy and boost asset prices essentially, and create a sort of wealth effect and deliver growth, and that was combined with essentially fiscal austerity. And what that meant was investors were essentially pushed up the risk spectrum in order to find a return. So out of cash, which was yielding negative returns, into bonds, and ultimately into equities, and to get the yield from equities. And what that meant was essentially people that could afford to own financial assets were the main beneficiaries of that, and people that were most impacted by fiscal austerity, i.e. the poorest parts of society, were negatively impacted. So it sort of had a double whammy effect, really, from an inequality perspective. But I think a lot of the the policies and the sort of the fundamental beliefs behind this are around kind of economic neoliberalism. So effectively the belief that there is an equilibrium price for everything. So if you increase the price, demand for that will fall. So in the case of employment, if you introduce a minimum wage, the view of the neoliberalist economists is that unemployment will rise because there'll be less demand for that employment. But I think what we've seen the world over is that introduction of minimum wages doesn't necessarily have a major negative impact on employment. In fact, it can result in employment rising. The reason being that if restaurant workers are paid more, then they can become customers of restaurants, and actually the restaurant business grows, and the pie overall grows. So I think that's the first thing that I think we need to challenge. The second is that price equals value, and I think that's a very questionable argument. If you think of a CEO earning $50 million a year versus the median wage or the average wage for a company on, say, $50,000 a year, is the CEO 1,000 times more valuable than the average worker? I think absolutely not. I think wages are not being determined by the value of the individual. Wages are being determined by the power and the strength of the corporate. So this sort of change that we've seen in the value of capital versus labour is not a function of labour becoming much less efficient. It's a function of employers becoming more and more powerful. And I think as corporates have become more and more powerful, I think the focus on purely shareholder and profit maximising has to stop, because those companies have such a meaningful impact on society. And I think I think we're starting to see that, and we're starting to see that really accelerate as a result of COVID-19. And I think the other thing is that the neoliberal economics asserts that all of us are rational profit seekers, and I don't think that necessarily is the case. I think what we are is people, is a society that collaborates, that solves problems, that sort of delivers solutions to problems, and I think that's more how sort of output and productivity should be measured.
I see. So, I mean, to bring you back to QE for a moment, I suppose I would question a little bit of your thesis, in the sense that when the Bank of England reviewed the impact of quantitative easing, and I admit that it's probably a little bit out of date now, it was reviewing it between 2008 and 2014, the Bank of England found that the impact of QE was actually the benefit of QE was not top-loaded, it was bottom-loaded, that actually the poorest in society and those with the least asset wealth had seen the greatest benefit from QE. So I suppose I'm curious whether you think that the bank got it wrong, or whether you think that actually there's been a change since that 2014 to 2020 situation.
Yeah, I think initially, in terms of what QE needed to do was to save the financial system in the short term. If we sort of go back to 2008, 2009, and then sort of 2012, where there was a serious danger that the financial system would collapse, and a serious danger that the eurozone would collapse. I think in terms of restoring stability and keeping keeping things going, I think it served its purpose, and it did a good job. But I think the further and further we've gone in terms of monetary easing, and interest rates have gone more and more negative in absolute terms, or at least in real terms, the efficacy of monetary policy, quantitative easing, has reduced further and further. And I think I guess the chart on the right hand side, and what we talked about in terms of in terms of populism, etc. I think we get to a point where fiscal stimulus becomes I guess the way to get the economy going, and also the way to redress the inequalities between the rich and the poor. And I think what we're seeing. It's interesting. At the beginning of this year, I was talking quite a lot about how we're likely to see a big step up in fiscal policy. I obviously had no idea what we were going to see in February, March. But I think this has provided a real catalyst for that to happen, because I think there's now a lot of there's clearly a huge amount of political cover for fiscal stimulus to happen. And I think also what we're likely to see, and as you mentioned in the introduction, what we saw yesterday was that fiscal stimulus is likely to be green. So the kind of the green recovery that was much talked about after the global financial crisis didn't really materialize, because there wasn't really a great deal of fiscal stimulus. Whereas now we are seeing fiscal stimulus, and we're going to see a lot of fiscal stimulus. And I think there's a lot less political pushback if that is directed towards green investment.
I think you've really well articulated where you think the drivers for the sort of the requirements, or the drivers for the new sustainable capitalism thesis is coming from. I suppose what would be good now is to move on to what do you mean by sustainable capitalism, and how and what does it mean? How is it going to impact things like supply chains? How is it going to impact the performance of companies?
Yeah, I mean, well, capitalism, broadly speaking, is one characterized by free markets where the government has limited intervention. Obviously, the government needs to step in to provide those sort of products and services that might not get provided by the free market. For a capitalist economy to survive, it needs to grow, and markets need to support expansion. And I think, generally speaking, there's a belief that capitalist systems are sort of destructive from an environmental perspective, and also have, as maybe we talked about in the last few minutes, they impact negatively certain individuals that don't have proper representation. So sustainable capitalism is based on the idea that the overall pie can grow in a way that also seeks to preserve humanity, to preserve the planet, while reducing externalities, and also bearing a sort of strong resemblance to a capitalist economy. I think what interests me most is the more micro level. So sustainable companies and sustainable industries, and how companies can act in a sustainable way in order to deliver long-term growth, but also I guess focus not just on shareholders but on all stakeholders, and grow the pie broadly for all of society, rather than just thinking about how to divide that pie up and get a greater and greater share for the 1%.
I see. Okay, so I mean, for example, I mean, if we just think about what do you feel that there's going to be, as part of the fiscal element of things, do you feel that there'll be a big drive for changes in regulation? I mean, I know that we've been talking about fiscal stimulus and inequality. Do you think that will lead to a rise in government regulation over companies, and how will that affect investors' decisions? Or do you think it's actually the other way around, that a desire for more socially responsible, perhaps, or more socially concerned or active investments will drive investments, and it'll almost be that the regulators will be catching up with what everybody else is already doing and what the market is already demanding.
Yeah, I think it's a great question. I think it's a bit of both. I mean, I think there has been over recent years a growing awareness of stakeholder capitalism versus pure sort of market shareholder capitalism, but I think the pandemic has really accelerated that move towards prioritizing employees and society over shareholders. I think to your point, I think there is an element of self-interest here, because companies are some companies are probably trying to gain favor with regulators, with governments, and improve their standing in the public eye. But I don't think that's necessarily a bad thing. It doesn't matter necessarily what the motives are for doing it, provided the outcome is the right way. But I think what we are seeing is that companies are changing the way that they allocate funds. We'll see a big reduction in buybacks. We're seeing a reduction in dividends, and instead of purely focusing on those shareholder returns, they're focusing on guaranteeing jobs, providing extended sick leaves, so health coverage, childcare, all those sort of things. So I think this is being it's being very much driven by the bottom up, by the individual companies, and I think there are a lot of really interesting examples of this that we've seen over over the last few months. You mentioned about sort of supply chains and what have you. I think what I guess the sort of the backlash against globalization more broadly, but there's sort of the recent pandemic, what it's really shown us is how important it is to have strong, resilient supply chains, and I think that means a shift away from just-in-time type production processes to more sustainable supply chains, and probably more localization of production. So that doesn't just mean having the factories nearby. It also means much more sustainable production processes, and making sure that your suppliers, etc., have strong ESG credentials, because of the negative impact that it can have, as we've seen with Boohoo and others recently. A really good example of that is a Chinese company, and not that long ago you wouldn't have heard many people talking about strong ESG in China, but China Menu, which is a dairy company in China, over the course of the last few months, rather than putting pressure on their suppliers, and rather than reducing their demand from their suppliers, they've actually maintained their contracts. They've essentially maintained those procurement obligations. They've offered interest-free loans to their suppliers, and rather than just dumping the milk that they've been receiving, they've been sort of turning it into powdered milk so they can store it and use it later. And all of those things mean a meaningful hit to the top line in the short term. So that impacts profitability for 2020 certainly. But what it does is it builds up the resilience, the sustainability of their supply chain. It also increases significantly the loyalty of their own staff, but also of their suppliers, and I think fundamentally improves the sustainability of the company over the long term. I think, and I think there are other examples. Salesforce, which is an IT company, but which sent planes full of PPE to New York at the height of the crisis, and we've seen also perfume manufacturers turn their production lines to make hand sanitizer, other fashion companies producing PPE equipment. All of these things have there's a material sunk cost of doing that in converting the production line to produce this other produce, and historically that would have been negatively thought about from a shareholder value perspective, because it is a short-term hit to earnings. But I think there's a fundamental shift there, that by doing these things, by doing the right thing, you increase brand loyalty, you increase your employee loyalty, and that fundamentally over the long term increases the sustainability of your business and increases profits in the long term.
I mean, at the risk of making myself unpopular, perhaps that's already the case with some of my colleagues, but I'll take that risk with the wider listeners anyway. I mean, you've just described companies undertaking production of PPE and of perfume companies. I think the obvious one was always the Louis Vuitton group changing production to make hand sanitizer. I mean, one might argue that, well, that's actually just a relatively speculative, reactive way of maintaining cash flow in a period where it's unlikely that we're going to be wanting to purchase perfume. Similarly, with the Chinese company that you mentioned that was looking to make powdered milk, maintain relationships and payments to suppliers. Again, at the risk of making myself unpopular, could that be construed as just looking to maintain market share? And also the general points that you were making about companies reacting in a way that will sort of maintain their reputation. Well, again, the companies are looking to produce as much as possible and sell as much as possible, not only during the pandemic, but afterwards. And so are reacting to the market in order to increase long-term their bottom line. It's all sounding dangerously like the neoliberal economics that you were telling us perhaps is falling out of vogue, with the only real change is that perhaps we're seeing a move away from the short-termism into a more long-term point. So I suppose, again, to sort of turn it around a little bit, is this a fundamental change, or is this just an evolution?
I think it is a fundamental change. I think I guess the examples I gave and the pushback you gave on that, none of these companies were making profits on the PPE or the hand sanitizer, and actually there was a material sunk cost in doing it. So it wasn't a profit maximizing behavior. It was quite the opposite. And I think likewise with China Menu. This was all product that they were not going to be able to sell. What they were focusing on really was I guess doing the right thing by their suppliers and maintaining the resilience of their supply chain longer term. And I think by doing that and also by I think one of the big sort of positive outcomes of this is you increase significantly your how your employees think about the company and their sort of trust in the company, and that has and I think also by maintaining staff through this crisis, whether that's through furlough schemes or not, in many cases not, you don't have to then re-employ these, retrain, re-employ people in a year's time or 2 years' time. So I think there is a much more sort of long-term view being taken, and I think it is a fundamental shift away from purely focusing on the shareholder. And I think there is there's certainly a degree of it's partly the right thing to do, but also it is in company self-interest to do it, but I don't think that's necessarily a bad thing, and I think it will continue, because we're seeing huge inflows. I think over the last few months we've seen sort of 40 billion plus of inflows into sustainable strategies and sort of $300–400 billion of outflows from non-sustainable strategies. When you look at fund flows, and what that's telling you is that capital is flowing into companies that have good ESG sustainability characteristics, which means that the cost of capital for those companies will continue to go down. The cost of capital for companies with poor ESG characteristics will continue to go up. So there's, it makes financial sense to be doing the right thing as well as it being the right thing to do. And I guess shorter term, the slide that you're showing there, what we've what we've shown is this is breaking down market performance for credit and for equity over the course of the market sell down correction that we saw in March, April, and we've split the market by our proprietary ESG scores, so A through to E, with A being strong and E being weak, and you can see that for both equity and for fixed income, there's a pretty linear relationship between the quality of a company's ESG characteristics and how it performed, how well it held up during the market correction, and I think that can only make this continue, because there'll be more money as a result flowing into companies that are A and B rated on our sustainability scores, and less going into those D and E rated companies, which means that it will become becomes harder and harder for those poorly rated companies to fund themselves, and they'll have to improve in order to move forward.
Great. Well, I mean, it seems like that's a good slide for us to leave on. First of all, thank you very much for your time. I found it very interesting and very challenging personally, and hopefully all of our listeners have as well. For all of our listeners that have come on, thank you for joining us today. All of our webcasts are available on our YouTube channel or through the Arling Close website. And if you do wish to know a little bit more about ESG or sustainable capitalism or any of the things we've talked about, my colleague Feroza Katrak has got a wealth of knowledge in this area, and will be more than happy to discuss with you. So please do get in touch. If you have any questions on Fidelity or on any of the Fidelity funds, or if you've got any follow-up questions, really, do get in touch, and I'll make sure to pass them on to Toby. So I suppose all that remains is for me to remind you all to follow us on Twitter, which is just @ArlingClose, and finally to thank Toby and wish you a good day. Thank you very much, Toby.
Thank you very much.